A very good morning to our doctor and my fellow friends. My name is Madhutani Arivalakan. My metric number 264931. Today I would like to present about the case 3, the smell, taste and touch of money and accounting policy decision. Now I will continue to the part executive summary. Based on the case given, there are three major problems faced by MIM Holdings. The first problem is, does UPC exercise excessive power and control over MIM in acquiring the investment? The second problem is, the classes of shares for the injected fund were not stated in MIM's constitution. Would recognition of the injected fund as debt drag the solvency of the company? The recommended plan for first problem is, the UPC should exercise its power and control over MIM in line with MFRS 10 to avoid the violation of MIM's independence in decision-making process. The recommended plan for second problem is, MIM should amend the classes of shares in the Constitution in line with Section 90 subsection 1 of Companies Act. The recommended plan for third problem is, Aina, the accountant of MIM, should undertake solvency ratio analysis to evaluate MIM's solvency. Now I will continue to the part statement of problem. Based on the case given, MIM Holdings was facing three major problems. The first problem is, UPC exercised excessive power and control over MIM. In 2017, UPC exercised excessive power and control over MIM in acquiring the investment. The acquisition of the investment appeared to be a golden opportunity since the selling price of the investment was attractive and below its fair value. Therefore, UPC influenced MIM's decision making in acquiring the investment because this investment opportunity could benefit MIM to achieve its objective of generating more income for UPC. This shows that UPC was exercising its power and control over MIM without complying the accounting standards set under MFRS 10. Therefore, the external auditors of UPC should ensure that whether UPC is complying with all relevant accounting standards when engaging with MIM. The second problem is, the classes of shares for the injected fund were not stated in the MIM's constitution. Aina recognized the injection of fund of 18 million as current liability, which was termed as redeemable convertible cumulative preference share. However, MIM's article of constitution did not include any equity other than ordinary share. This shows that the company did not follow its constitution and Companies Act in issuing the fund as redeemable preference share. Therefore, the company secretary should redraw MIM's constitution by incorporating the preference shares under class of shares. The third problem is, would recognition of the injected fund as debt drag the solvency of the company? Since MIM recognized 40 million ringgit of Islamic bank loan and an additional liability 18 million ringgit of fund transfer, it might affect the leverage and solvency of the company since it increases the liability of the company. In 2019, the external auditor KHR drew attention to the material uncertainty that relates to the going concern of MIM, that the group incurred a net loss of 3,616,321 ringgit during the year ended 31st December 2019, and the group's current liability exceeded its current assets by 4,644,718 ringgit. This indicates the existence of material uncertainty which may cast significant doubt about the group's ability to continue as a going concern. Therefore, Aina should perform a solvency test to see whether MIM's recognition of the injected fund as debt adversely impact its solvency and its future operation as a going concern. Now I will continue to the part recommended solution. To resolve problem 1, UPC should exercise its power and control in accordance with MFRS 10. For instance, UPC exercises its power and control over MIM when it has existing rights to direct all relevant activities that have significant impact on MIM's return, rights to variable return from its involvement with MIM, and ability to use its power over MIM to affect the amount of UPC's return that does not violate MIM's independence in decision making. This is because MFRS 10 established a detailed guidelines for power and control over a subsidiary. Therefore, UPC could have a better understanding on what extent it can exercise power over MIM. These guidelines could influence the UPC to avoid exercising excessive power and control over MIM. This will also prevent MIM from navigating complex group structures and information flow and reduce the conflicts arising from UPC's expectations. Therefore, MIM could improve its involvement with UPC in decision making that produces more effective group decisions. There are two causes of problem 2. The first problem is no compliance of Companies Act 2016. In accordance with Section 90 subsection 1 of Companies Act, if a company has several classes of shares, the company's constitution must mention clearly that the company's share capital is divided into different classes of shares as well as voting rights attached with those shares. However, MIM was not complying with Companies Act since it issued the redeemable preference shares of the injected fund which was not stated in the MIM's constitution. Therefore, MIM's company secretary had to revise the article of constitution to incorporate the different types of equity financing such as preference shares and voting rights attached to those classes of shares. The second cause is the company secretary did not perform duties effectively. One of the responsibilities of company secretary is to ensure that the company is compliant with all relevant laws and regulations. In this case, the company secretary did not perform duties to advise MIM in recognizing the preference shares of the injected fund since the company did not state the classes of shares other than ordinary shares in its constitution. Therefore, it is the company's secretary responsibility to ensure that the recognition of preference share was in accordance with its constitution and drafting alteration of. The third cause of problem 3 is material uncertainty related to the going concern of MIM. In 2019, the external auditor of MIM, KHR, drew attention to the material uncertainty related to the going concern of MIM. This is because the group incurred a net loss of 3,616,321 ringgit during the year ended 31st December 2019, and the group's current liability exceeded its current asset by 4,644,718 ringgit, which indicates the existence of a material uncertainty which may cast significant doubt about the group's ability to continue as a going concern. Therefore, INA should test whether or not MIM can continue to operate as a going concern in the immediate future in accordance with Section 112 of Companies Act by using solvency ratio analysis. Therefore, the Board of Directors of MIM could prepare a solvency statement which indicates their opinions that MIM satisfied the solvency test in relation to the transaction in compliance with Section 113 of Companies Act. Now I will continue to the part decision criteria and alternative solution. To propose solutions for problem 3, INA has carried out an analysis on legal compliance to evaluate whether UPC and MIM are operating in line with relevant accounting standards and Companies Act. Moreover, she wants to see whether MIM could operate as a going concern by using some numerical approach, and she is aware that the accounting information is very important to influence her decision. Therefore, Aina has carried out two types of ratio analysis to evaluate a decision on MIM's solvency. There are two alternative solutions that can be proposed for problem 1. The first solution is UPC should comply with MFRS 10 in exercising its power and control over MIM. The UPC should comply with all relevant accounting standards such as MFRS 10 when engaging with MIM. This is because one of the power of the parent company was set under MFRS 10 is that the parent company is exposed to variable returns from its involvement with its subsidiary. Therefore, UPC should involve with MIM in the decision making process so that MIM might give its opinion in the acquiring the investment. The pros of this solution is to avoid UPC from exercising excessive power and control over MIM. The cons of this solution is these accounting standards might be complicated for UPC to implement in group decision making. The second alternative solution is UPC should draft the Articles of Constitution. The UPC should draft the Articles of Constitution by incorporating certain provisions regarding its control over MIM. For instance, UPC may include provisions detailed by standards defining the authority of UPC as a parent company and MIM's corporate officers. The pros of this solution is the management of UPC and MIM have a clear understanding on what extent they can operate. This will also improve MIM's involvement in the decision-making process. The cons of this solution is sometimes the subsidiary company might be dissatisfied with the provisions set by the parent company. Therefore, UPC requires MIM's agreement towards the provision. Furthermore, the first alternative solution for problem 2 is MIM's company secretary should amend the classes of shares in the Constitution. The company secretary should incorporate the redeemable preference shares and its voting rights under the classes of shares in the Constitution, which is in accordance with Section 90, subsection 1 of Companies Act. This is because it is company secretary's responsibility to maintain the company's records, such as classes of shares and its voting rights. The pros of this solution is the company covers MIM's classes of shares and its voting rights to ensure that it is appropriate for each of its shareholders and that the company runs smoothly. The cons of this solution is the process of altering MIM's constitution might consume a great time due to the need to obtain shareholders' approval. The second alternative solution for problem 2 is MIM's company secretary should perform her duty in ensuring the compliance with legal requirements. The MIM's company secretary should ensure that the management activities and the decisions implemented by MIM in issuing the preference shares are in line with Companies Act. Then the company secretary should advise the management on the legal requirements for the issuance of preference shares. The pros of this solution will enhance the compliance of the legal and statutory requirements, particularly in the administration of MIM. The cons of this solution is the company secretary might overlook the legal and statutory requirements, which might affect the company's performance and reputation. Moreover, the first alternative solution for problem 3 is Aina should undertake debt to equity ratio analysis. Aina should evaluate MIM's solvency by calculating debt to equity ratio for the year 2016, 2017, 2018 and 2019. The debt to equity ratio of MIM for the year 2016, 2017, 2018 and 2019 is 0.79, 1.24, 3.42 and 4.04 respectively. Aina should calculate debt to equity ratios because these ratios indicates how MIM is funded, in this case by debt. Therefore, Aina could make a decision whether the recognition of the debt impacts MIM's financial leverage. Based on the analysis, the debt to equity ratio has increased from the year 2016 to 2019. The debt to equity ratio for the year 2016 is 0.79, shows that the MIM was using 79 cent in debt financing for every ringgit Malaysia of equity financing, which is considered good by industry standards. Since the debt to equity ratio for the year 2017 to 2019 grows larger every year, MIM is becoming more highly leveraged by debt. Therefore, MIM is to be considered a risky investment by lender and potential investors. The pros of this solution is the debt to equity ratio indicates the risk of a company. A high ratio implies greater risk as the interest expenses associated with debt is also high risk for a high debt company like MIM, and it is mandatory outlay even when the company is not making any profits. The cons of this solution is the debt to equity ratio analysis of MIM is not efficient in evaluating its solvency since the company's financial leverage kept decreasing every year. The second alternative solution for problem 3 is Aina should perform debt to asset ratio analysis to access MIM's solvency. Based on the analysis, the debt to asset ratio of MIM for the year 2016, 2017, 2018 and 2019 is 0.44, 0.55, 0.77 and 0.8 respectively. Aina should calculate the debt to asset ratio because it indicates the percentage of total assets paid for with borrowed money represented by debt on the balance sheet of a company. This analysis will help Aina to make a decision whether the recognition of debt drags MIM's solvency. Even though debt to asset ratios increase from year 2016 to 2019, where the ratios are less than 1, it indicates that the MIM's assets are largely funded by equity and the risk of default and insolvency is low. The ratio indicates that MIM has a low risk of defaulting on loans, which can be beneficial if MIM continues its operation as a going concern. The pros of this solution is the use of the debt to asset ratio is to evaluate whether a business has enough funding to meet its obligations. The cons of this solution is if the debt to equity ratio is calculated incorrectly, it might affect the interpretation of the ratio, resulting in inaccurate analysis. The third cause of problem 3 is material uncertainty related to the going concern of MIM. In 2019, the external auditor of MIM, KHR, drew attention to the material uncertainty related to the going concern of MIM. This is because the group incurred a net loss of 3,616,321 ringgit during the year ended 31st December 2019, and the group's current liability exceeded its current asset by 4,644,718 ringgit, which indicates the existence of a material uncertainty which may cast significant doubt about the group's ability to continue as a going concern. Therefore, Aina should test whether or not MIM can continue to operate as a going concern in the immediate future in accordance with Section 112 of Companies Act by using solvency ratio analysis. Therefore, The board of directors of MIM could prepare a solvency statement which indicates their opinions that MIM satisfied the solvency test in relation to the transaction in compliance with Section 113 of Companies Act. To resolve problem 2, the company secretary should alter the classes of shares in the constitution. For instance, the company secretary should incorporate the preference shares and its voting rights under the classes of shares in the constitution in accordance with section 90 subsection 1 of Companies Act. This is because the Companies Act allow MIM to issue the classes of shares that have been stated with its voting rights in the company's constitution. Therefore, this is to ensure that MIM's constitution is appropriate for each of its shareholders and that the company runs smoothly in line with legal requirements. To resolve problem 3, INA should use debt to asset ratio analysis to evaluate MIM's solvency. For instance, INA should calculate and interpret the debt to asset ratio analysis from the year 2016 to 2019. This is because this ratio helps INA to analyze whether the recognition of injected funds as debt drags MIM's solvency. This ratio also indicates whether MIM is able to meet its obligation when MIM faces a material uncertainty that is related to the going concern in 2019. This is because this ratio implies the level of default or insolvency risk which could be beneficial for MIM to decide whether it continues its operation in the immediate future as a going concern.